Let's begin with qualified tuition programs or 529 plans, a major topic on the enrolled agent exam. Contributions to a 529 plan are not deductible on your federal income tax return. A common point of confusion because some states do offer a tax deduction or credit. For the federal exam, remember, contributions are made with after-tax dollars. The key federal benefits are twofold: tax-deferred growth and tax-free distributions. As long as the money is withdrawn for qualified higher education expenses, the growth is never taxed. These qualified expenses include tuition, fees, books, supplies, and required equipment. The exam may also test you on room and board, which qualifies if the student is enrolled at least half-time. The exam loves to test the boundaries of these rules. For instance, recent legislation now allows for up to $10,000 per year from a 529 plan to be used for tuition at an elementary or secondary public, private, or religious school. This is a critical update. Another significant and highly testable recent change is the ability to roll over 529 funds to a Roth IRA for the beneficiary. However, the rules are strict. The 529 account must have been open for more than 15 years, and the amount rolled over must have been in the account for more than 5 years. There's also a lifetime rollover limit of $35,000. Expect scenario questions testing these specific limitations. Now, what happens when a distribution is not used for qualified expenses? This is a favorite exam calculation question. The earnings portion of a non-qualified distribution is subject to both ordinary income tax and a 10% penalty. The contribution portion, which is the principal, is returned tax-free. The key is the pro rata rule. For example, imagine a 529 account with a total value of $80,000, consisting of $50,000 in contributions and $30,000 in earnings. If the owner takes a $20,000 non-qualified distribution, you must determine the taxable portion. The earnings ratio is $30,000 divided by $80,000, which is 37.5%. Therefore, 37.5% of the $20,000 distribution, or $7,500, is considered earnings. This amount will be taxed as ordinary income and hit with a 10% penalty. The remaining $12,500 is a tax-free return of principal. Let's contrast this with the Coverdell Education Savings Account, or ESA. The exam will expect you to know the key differences. The most significant is the contribution limit. For a Coverdell, the maximum contribution is only $2,000 per year per beneficiary. This is far less than a 529 plan. Furthermore, the ability to contribute to a Coverdell is subject to modified adjusted gross income phase-outs. High-income taxpayers cannot contribute. 529 plans do not have these income limitations. Another critical distinction is the age limit. Coverdell funds must generally be used by the time the beneficiary reaches age 30, whereas 529 plans have no such age restriction for the beneficiary. A common exam trap is to present a scenario with a high-income taxpayer and ask which account they can contribute to, with the 529 plan being the correct answer. To help you remember the new rollover rule, use this phrase: for a 529 to be secure for retirement, it takes a 15-year wait and a $35,000 key. This connects the Secure Act, which introduced the change, with the 15-year account requirement and the $35,000 lifetime limit, hitting the core testable elements of this valuable new provision.